Hello, I hope everybody's doing well as we approach the end of the week. And I just wanted to come on today. I had a question about the expanded counting equation, and I wanted to hopefully give some examples and just try to better explain that or if there's any confusion about that. And I think it's a good question, particularly as we begin to get ready for the Unit 1 quiz. So without further ado, we will go ahead and switch over and I'll work through this. So if you remember early on, our assets are equal to our liabilities plus our equity. And if you remember what these types of accounts are, we've got assets are those things that we have that are valuable, that are desirable, that we could then turn and convert to cash. So for instance, cash is going to be the most liquid asset. There's nothing more liquid than cash, but receivable is a promise to pay us in the future that later becomes cash. If I have supplies that I'm going to be using in production, I want to use those to generate revenue, which will eventually become cash, that sort of thing. So assets are things that are valuable. Liabilities are claims against those assets. They're loans or they're debts that we have incurred as the result of the purchase of an asset. And then equity, of course, is our net worth. It's what we're valuable. It's what we're worth as far as that goes. And I gave the example early on of buying a house, and of course the house would be the asset, and the mortgage would be the claim against the asset. And if I had, a 20% down payment up front, and so I paid that in cash, then I would own 20% of the house at the very beginning. That would be my equity or my net worth. So the expanded equation really builds upon some of the stuff that we're going to look at when we get into closing entries. But for the purposes of illustration today, think about, as we were reviewing debits and credits, remember you had debits, credits, and we had normal balances for each of these. So we had debits and credits, which simply means left and right. So for assets, a debit was an increase, credit was a decrease. Yeah, I know. There we go. I'll get there eventually. Got too many of these here. And then for liabilities, a debit was actually a decrease. Credit was an increase. And same thing over here for equity. And that's how those balances work. Okay. Now it's pulling the wrong way. Okay. And there we go. Perfect. And so if you think of it, if it's true that on the left side of the accounting equation, entries on the left side cause that to increase, those assets to increase, then on the right side of the equation, anything that's going to incur on the right side is going to cause this side of the equation to increase. The exception, of course, would be an account that would reduce one of these balances. And so let's focus on revenue. Let's focus on equity rather, and how revenue and expenses affect that. Under the expanded equation, we begin with equity, and what we've learned about right now is really common stock or ownership in a company that represents equity. But if you think about it as a business, if I have an organization or company that generates revenue, what I hope happens is I generate more revenue than expenses. If I do that, then I'm profitable. If I generate more expenses than revenue, then I'm losing money. And so knowing that, basing off of that presumption, if equity is increased by credit and decreased by debit, wouldn't it make sense then, since revenues flow into equity and revenues are good and positive, that revenues would behave in the same way? Meaning that in addition to other equity items, revenue is going to be decreased by debit and increased by credit. And then the opposite would be true with expenses. As I mentioned before, when we were going through and you were looking at financial statements and you began with, you looked at your revenue items and you had, say, for instance, you had, let me do a plural there. Say you had sales of $10,000. And then for expenses, I'm going very simply here. You had cost of goods sold, 5,000. If those are the only two things that we have, our net income or loss is going to be the difference of these two accounts. In this case, I had 10,000 revenue minus 5,000 in the cost of goods sold, which means I have positive net income. Now, if I had a situation where my revenue was 4,000, that's going to be a loss. So remember that as I'm talking through this. Revenues behave just like equity. Revenues are decreased by debit, the left side entry. They're increased by credit. Expenses are exactly the opposite. They are, I'm gonna pull it from assets over here. They really behave just like assets do. They're increased with a debit and decreased by credit, because again, these are in opposition, working in opposition to those items that produce revenue. So for instance, if I produce a product and I'm going to use that product in resale, I've got to have items or factors of production to be able to produce that product. So whatever I sell it for, I've got a cost incurred within it as well, whether that be physical materials that go into it, whether that be manpower, hours, and that type of thing. Those are all factors that I have to consider when I get to this bottom line number. In this first example, when I had $10,000 in sales, again, that's what the public pays for what I sell. And I only have 5,000 in expenses. Again, very simple, kind of unrealistic example, but just assuming that I had $5,000. So in that instance, if I had total assets of $200,000 and I had total liabilities of $150,000, again, just a very simple example, my equity is going to be, here really what? It's going to be the difference between the two of these, right? And so going off that same premise, I'm at 200,000 and 200,000. In this situation, if I had revenues of 10,000 and I need to put it on the right side, I suppose, 10,000, and I had expenses sitting over here at 5,000, I know the net difference between these two items is $5,000 in my favor. What that's going to do eventually is it's going to cause this number to jump to 55,000. Because I'm recognizing income, I'm recognizing revenue. Now, what's the other side of that equation? Depending on how I was paid, if I was paid with cash, it's going to be over here as an increase to cash. So the asset cash would be increased by 5,000. If it was paid as a receivable, it's going to be increased by 5,000. If it was paid in 5,000 in equivalent equipment, it's going to be an increase of 5,000 in equipment. But regardless, I know that if I have an increase on the right side, I've got to have an increase on the left side as well. In this case, it's an increase to assets. So I probably shouldn't have made that an absolute number. So F6, yeah. So as I see right here, as a result of this transaction, my total net worth grew by $5,000. And doesn't that make sense? Because if I'm a business and I'm showing that I'm profitable, as I've done over here, 5,000 net income, that now I'm worth more. And the opposite would be true if I was losing money. So that's just a really simple example of how the expanded accounting equation works. And it's a good place for you to be at right now if you can understand the way that transaction is flowing. The closing process will really formalize that quite a bit, and you get a chance to really see how we properly do that transaction. That's coming, I promise you. But right now, it's enough to understand that when you think about the accounting equation, assets equal liabilities plus equity, that revenue serves to increase equity, that expenses serve to decrease equity. Revenue, basically, what increases revenue is the same type of entry, a credit, that would increase a liability or an equity account. Expense, the thing that would increase in expense, it acts like an asset. A debit increases in expense. And of course, a credit decreases it. So if you have any questions, please let me know. Thank you so much.